It's Saturday, January 26, 2019. I'm Justin Castelli, CEO of RLS Wealth Management, and welcome to your All About Your Benjamins weekly mixtape and weekend review. Make sure to stay tuned as I'll be covering the government shutdown, the U.S. markets, the Federal Reserve, China's slowing economic expansion, housing, and investors hoarding cash. Welcome to another weekend review video. Let's get straight to the headlines impacting or maybe not impacting your financial plan and investments. And we will start right away with the government shutdown being ended last night on a temporary status. So there has been a 3-week fix. The government employees that have been out of work can go back to work now and will receive their back pay, but it's only temporary. We have a 3-week fix, so if nothing has been agreed upon in the next 3 weeks, we get to do this all over again, and if I had to guess, we might be doing it again. If it does occur, hopefully it's on a much shorter time horizon, as both sides can kind of take this next 3-week period to really be serious about getting things fixed and moving in the right direction and doing what's best for all of us and the government employees, and not just kind of having this back and forth headbutting that we've seen over the last couple of years. That's the end of my political rant. Try not to get too political, but I'm hoping that they can actually set their differences aside and come to a good agreement so we don't have to go through this again. Heading right out of that, we'll go into the markets this week. Not a lot of commentary. It's a 1-week period in a 20, 30, 40, 50-year investment horizon, so I don't want to put too much weight on what happened this week, but the markets ended the week up higher, continuing the trend of higher weekly moves on the market. One of those reasons that at least it ended higher, so Friday there was some news out of the Federal Reserve that they might be considering unwinding their treasury sales, which would give them a larger portfolio of U.S. treasuries. So not to get into the weeds and what that is, but this would be something that would be occurring sooner than expected, which the market seems to like. So there will be a meeting next week. Federal Chairman Powell will be talking about what they're going to do when it comes to unwinding and potentially slowing this unwind or halting the unwind of these U.S. treasuries and keeping more on hand. There's an article in below from the Wall Street Journal if you want to learn more about what that process is and why they might be doing that. Check that out. I don't want to go into all those details here, but just know that the Federal Reserve has been a very influential source on the markets over the last year, whether it be interest rate hikes or comments about the future. So this sets up that potentially next week there could be some market turbulation, higher or lower, who knows, depending on what comes out of the meeting. So are they going to stop the unwind? Will they say anything else about their future plans with interest rates or any other comments that might move the market one way or another? You probably shouldn't be reacting on it or even anticipating it, but just want you to be aware of something that might be coming up next week that we might be talking about on next week's video. We will move from there to China. China announced their economic expansion. It's slowing, so it's at 6.6%. It's the slowest growth since 1990. A few comments here. One, 6.6% economic growth is still pretty strong. However, it is coming from China, and it's not that we can always trust the numbers that China reports. Just difference in governments and the way things are set up there. So I would not put a lot of weight behind these numbers, but it is important to know as a global allocator, as a believer in a globally diversified portfolio, I think it's important to understand the why behind what our portfolios might be doing. So why are international funds doing what they're doing? We still want to have them in the portfolio, and if you understand why they're doing what they're doing, I think it makes it easier for you as an investor to stick with your plan and keep that in there. So I don't think you need to be making any portfolio changes. Last week we talked about the euro and Germany and what's going on there as far as slowing. Now we see signs of China. I've got to believe that the trade disagreement between us and them has had some impact on that growth. But again, not talking about this or bringing this up because I think you should make changes. I just think that it's important for you to understand the why and not necessarily to try to come up with a game plan to react to it. Just knowing, I think, gives you more confidence and ability to stick to your plan. Stay with the course, as Jack Bogle would say. Housing, a couple articles that I've included about housing, because that's a big part of the economy and people talk about it. December, home sales slowed, housing prices slowed on their rising values as well. So we see some, I won't call softening, but just some slowing and some weaker information coming out of the housing market. That was December though, so I don't know how much I'm surprised by that, just given that, you know, it's rising rates, long time into housing doing pretty well, end of the year. You know, you can find a number of reasons why that may not be a big surprise. The other article that I included is not necessarily headline driving, but something that's worth looking at and noting. There's an article that is down in the notes about the no loan or no documentation loans coming back into the picture. So if you're not familiar with these are loans that basically banks are issuing without formal documentation of income. And there are people who have unique situations where this is necessary, but these are the loans, or one of the types of loans that were very prevalent when it came to the housing bubble, which led to the financial crisis. So not that it is going to be a repeat of 2007, 2008, but I think it is worth noting that these loans are finding their ways back into the system as interest rates are rising, maybe slowing down the demand for loans. Banks are getting a little bit more lenient, maybe a little bit more greedy in the fact that they want to continue that loan growth, so now they're going to expand who they're giving money to beyond the normal loan qualifications they needed before. So just worth noting. I have a funny story about no loan documents if you want to hear that, about when my wife worked in real estate and the no loan document customer that was sold a house. Hit me up on Twitter, I'd be happy to tell you that story. And then finally, there's an article that is down below about investors hoarding cash. Bring that up not because it's a recommendation that you should be doing it, but as volatility has come back, and we've seen a down year last year, and although the markets are up so far this year, a little bit more volatility, it's spooking investors a little bit. I only bring that up because there are a lot of people who are still sitting in cash from 2008. Think about that. Where has the market gone from the bottom of 2008 until now? Sitting in cash is a tough thing to do because you've got to get your move right twice. You've got to get out of the market at the right time. You've got to get back into the market at the right time. So as investors raise that cash, I just put this out there to make sure if you find yourself wanting to do that, you find yourself doing it, make sure you're doing it for the right reasons. If these are funds you might need in the next 3 to 5 years, then it probably shouldn't be in the market and maybe never should have been in the market. If you have a short time horizon, those funds probably need to be in more conservative, safer investments. High yield interest rate in the savings accounts you can find online now would be a better place for short-term money. But if you're a long-term investor, you don't need these funds in the short term, then maybe you should reconsider why you might be wanting to sell. Is it because you're scared of the markets? Are headlines making you make this decision? Are the emotions getting the best of you? And if so, then it's probably best to, again, Jack Bogle coming back in, stay the course, stick with your plan, and not react and try to time the markets, because it's a losing game. It's a very hard thing to do. So the recap on that: short-term money should not be in the market, should be in cash or some very conservative investments. The longer-term stuff, I think getting in and out of the market's a tough thing to do. I would probably not recommend doing that. But it shows that investors are raising their cash holdings. So just be aware of that, and we'll continue to monitor that as well. So that is it for this week's Weekend Review. Be sure to check the Mixtape articles down below. Don't miss those. Some great pieces this week from some of my friends around the financial community. Be sure to subscribe to the YouTube channel. If you're listening to this on your Amazon device, I will promise not to say the name anymore. Be sure to head on over to allaboutyourbenjamins.com to check out all of the articles supporting today's Weekend Review video, and also for the Mixtape as well. Give us some likes. Be sure to subscribe to the podcast as well. Have a couple great conversations coming out in the next couple weeks as well. So thanks for listening. Have a great week, and we will see you in the next episode.